let's jump into step one. So step one is understanding our tax brackets. This first area here would be our ordinary income tax brackets. And we have this progressive tax system where the more money you make, the higher your tax bracket is going to be. So if you're single and if your taxable income is $0 to $9,875, or if you're married filing joint and your taxable income is $0 to $19,750, you're in a 10% marginal tax bracket. Now, once you've exceeded the $9,800 for single or the $19,000 for married filing joint, all the way up for married filing joint to $80,250, you are in a 12% bracket. Once you go above those thresholds of $40,125 for single and $80,250 for joint, married filing joint, then you are now in a 22% bracket. So that's a 10% jump in your marginal tax rate. And then it just goes up from there. The news doesn't get any better. It goes from 22 to 24 to 32, 35, all the way to 37%, as I mentioned earlier in my intro. Now, 7 tax brackets. The more you make, the higher your tax is going to be. Here's a question for you, just so you can better understand how our progressive tax system works. Suppose you were at the top of the 12% ordinary income tax bracket and you earned $1 more such that you were now in the 22% bracket. Question is, what's the impact on your tax bill? A, my tax bill will go up substantially, or B, my tax bill will go up very little. Let me back up here and better define what I'm talking about. So let's suppose this married filing joint couple here has $80,250 of taxable income. So they're in a 12% bracket. And let's say that their employer says, hey, we're going to give you a $1 raise. And so now this year, your taxable income is going to be $80,251. And you go, I'm not so sure I want that $1 raise because now it's pushed me in the 22% bracket. So is that a good thing or a bad thing? Well, let's go back to our question here. If you think your tax bill would go up substantially versus going up very little, well, the answer is actually your tax bill will go up very little. So about half the people answer A, half answer B. And why that is, it's only that additional $1 that's now going to be taxed at the 22% rate. The first portion of our taxable income is at 10, then the next portion is at 12, and then the next portion is at 22. Now, where you find this information is look back at your federal tax return from the prior year. Look for that line item that says taxable income on the front page of your return, and that will tell you where you sit in this tax structure. It's the first thing you want to know because every decision that you make pivots on what marginal tax rate that you're actually in. So whether you're going to draw out of your IRA account, whether you're going to draw out of your Roth IRA account, whether you're going to draw Social Security, again, these marginal brackets are going to make a difference. Now there's another set of brackets, and that's going to be for capital gains and qualified dividends. They get a different tax treatment because what Congress has done is they said, okay, well, you're investing in a business and taking on risk, so we're going to give you a lower tax rate on the business income as well as the gains. So some of the businesses that you might be investing into, it could be real estate, it could be stock in a blue chip company, it could be investment type bonds. So there's many different types of investments out there. And how it works is they say, okay, if you have invested in something and it grows in value and you eventually sell that investment, as long as you've held it for a year, it qualifies for long-term capital gain tax treatment, which is at a lower rate. And I put this in a format of our tax map, which is a little bit easier way for you to see and visualize how the tax structure works. So as you'll notice here, this is for a married filing joint couple. They can take up to about $106,000 of long-term capital gain and still remain in the 0% tax bracket. before they go into the 15% bracket. So that's a pretty good deal, 0%. Let me give you an example of how you might put that to work for yourself. I was recently working with a gentleman that came to our webinar, and he retired from a Fortune 500 company where they had corporate stock, they had a pension plan, a 401k plan, and in addition, he is eligible for Social Security benefits, and they had some stock purchase shares. So in his plan, what we recommended is that he would defer his Social Security, defer his pension, and the first couple years of retirement, he would start to sell that employer stock. And we actually forecasted he'd sell the stock over a 3-year period and realize about $106,000 of long-term capital gain each of the next 3 years. And it would all be at the 0% bracket. So it doesn't get any better than that. So he is properly planning of how to take distributions and income from his plan in the most tax efficient manner. That's forward tax planning. So with capital gains, a couple items here to pay attention to. Make sure you take advantage of the low rates each year. So if you have a capital gain that you could realize at a 0% tax bracket, go for it. Step that investment up. In years that we have a market downturn, you might look at selling those capital assets in order to do what we call tax loss harvesting, where you take a loss and you can use that loss to offset capital gain, or you can actually use that loss to offset up to $3,000 of ordinary income. Secondly, explore the NUA tax rules, and these net unrealized appreciation tax rules apply to individuals that might have employer-held stock inside their retirement plans at work. So this is an opportunity for you to be able to get that employer stock out of those plans and pay these lower capital gain tax rates. So it's a specialty item in itself. If that's of interest to you in the seminar evaluation, let us know that, and I'll send you out some further information. Third thing here is hold dividend paying investments in non-qualified investment accounts. So oftentimes we see clients, they'll have their investment portfolio kind of flip-flopped where the dividend paying stocks are inside the retirement plan, and as those dividends are paid out, it's going to be taxed as ordinary income at those higher rates. Whereas if they're able to hold the stock inside a non-qualified retirement account, it would have the 0, 15, or 20% rate instead of the higher ordinary income tax rate. So take a look at your portfolios, and as you're accumulating and building, consider where you want to hold each type of investment.